guys, welcome back to another episode of The Trading Guys with me, Ryan Mack, and today I'm going to be taking things right back to basics. If, like me, you've watched hundreds of training videos before, and even courses, etc., that you purchase to learn how to trade, you may have noticed that there actually isn't many courses, if there is even one course, that takes you right back to the basics and actually tells you things like what is a pip. You know, you'll jump on the trading course and you hear these guys talk about getting 10 pips, 20 pips, 50 pips, and you're probably sitting there thinking, what the hell is a pip? Nobody even explains what a pip is, and that's something that I noticed as well when I thought I would make a video on that. So today, guys, excuse me, we're going to be covering the basics for trading, but they are super important because the whole of trading is based around that, right? So I'm going to be covering what is a pip, what is a candle, what is a spike, what is a directional bias or a trend, what are the EMAs, exponential moving averages, and I'm going to be covering all of that in some quite good detail here over the next kind of 10-15 minutes. Alright, I'm going to try and keep it as quick as I can, but as informative. So here we go. You will hear loads of people talking about pips, okay? Yeah, I scalped this for 10 pips, or I did a swing trade and I got 150 pips, and so on. So what is a pip, right? A pip is a unit of measure based on a monetary value. So 1 pip in Forex is the equivalent to $100 million being traded at any time, okay? Now, you have candles, right? So here is what a candle looks like, excuse me, and of course they can be any size, right? You might get one that's this size, you might get one that's even bigger than that, you might get one that goes like this and it's just tiny, you know, and so on. But if we just look at this one for now, this is a candle, right? And this is what's called spikes or pins, okay? And likewise, you'll see ones that are like this with massive spikes and pins, and then sometimes you'll see one which is a big huge body of a candle. We call this the candle, and we call this the spike, the pin, the wick, because it's the wick of a candle. You know, there's many names: spike, pin or wick, it's all the same thing, and that is essentially a candle. Alright, now within a candle and within a wick there are movements. You see the candle moves when you watch it on the market. So for every one movement, one solid movement of the candle, i.e. wick, etc., that is the equivalent to 1 pip. So if this candle measured, let's say 9 pips, right? This candle from here to here was 9 pips. That means that within here, there is the equivalent to $900 million being traded within this one candle, okay? And obviously if you measure it from here to here, it might be 17 pips, because of course you're going to include the wicks, right? So it may be 17 pips, which means it's $1.7 billion has been traded within this one candle. Okay, so what you'll see the market moves like this. So it'll come down, you may see this, obviously a candle, spike, spike. You may see one more going like this, right, coming up. So what happens is you have green candles and red candles. Some people change the colours to red and blue and so on. But if we go with red and green right now, if you see a candle which is red, right, R for red, and R for red again, and then green, right, what that actually means is this candle, it means that this candle started here. When this candle was first formed, obviously you didn't have any of this body, right? So it means that this candle was first formed up here. And because it moved down, obviously moved down to here, and then it came back up. Sorry, I'm mistaken. The candle was first formed here on this line. And then what it did is, it moved up, which would have been green at that point, but then it's came back down to give you this wick. The body has then moved down here all the way to the bottom, and then it's came back up to here to give you this wick. But because it ended lower than it started, this candle will now be represented by the colour red, which means it was a short candle, a sell candle, a going down candle, alright? This one is the same, so this means here that this candle started here, it pulled up, it came back down, which then leaves you with the wick. The wick just shows you where the candle has previously been in the market, but is no longer there, alright? That's what that shows you. It came down, pushed out, extended, came back up, and that's why it's giving you this wick here to show you where the market came to. And then the candle is finished here. When you see this here in the green, it means the candle actually started here and maybe pushed down first of all. So the candle started here, pushed down first of all, and then started pushing up. It pushed all the way up, came back down, and this is the main body, but it shows you the extremities of where that candle went. But because that candle finished higher than where it started, it is then a green candle, a buy candle, a going long candle, is all the different terms, okay? So while we're talking about that as well, I am also going to share with you the terms that people use, because I know sometimes that can be confusing as well. I wasn't actually going to do that in this lesson, but because we were talking about it, I thought I may as well cover it because it's very useful. So when people talk about the market going down, right? Down. And people talk about the market going up. Okay? Terms that can be used for the market going down can be bearish. Terms used for the market going up can be bullish. Okay? Again, terms used coming down, bearish, you can call it a short. Okay, you can call it a sell order. A sell or a sell order is fine. And you can also call them puts and pulls, but a put and a pull isn't really used in Forex. It's mostly used in trading stocks, so I'm not going to cover it, but they are called puts and pulls. So bullish, then you have long, going long, and you have a buy order. Okay, so these are the terms that people use. If the market's coming down, you'll hear people say we're anticipating a bearish run on the market. Bearish means they're anticipating the market coming down. We're anticipating the market going short. That means we're anticipating the market coming down. We're looking to do a sell order, which means the market's going down. All right. Coming up, yeah, we're anticipating the market's going bullish. We think the market's going up. The market's going to go long, means the market's going to go up. And a buy order, we're going to do a buy order, means that you think the market is going to go up, so you're going to place an order to buy. Some people don't know, when they're very new to Forex, that you can actually make money when the market goes up, and you can make money when the market comes down, okay? I've had people say to me before, how come I made money when the market went down? Well, that was why. It's because it's a sell order. So essentially, if you think the market's going to go down, you would place a sell order, and if you think the market's going up, you would place a buy order, okay? It's as simple as that. Spikes we have covered. I won't cover candle patterns because it's better if I just send you out the details of candle patterns. If anybody would like a copy of candle patterns to study, then put your, just say me or whatever in the comments below, and I will send you a free copy of the candle patterns so that you can study them and learn them, alright? Because they are very, very important. You must know about candle patterns. Directional bias and trend. At my company, we always called it the directional bias of the market. Most people in Forex call it the trend. Your trend lines, trend this, trend that. All that really means is what way is the market moving in general, because the market will always move up and down, right? So the market will always move like this, But a trend line would be what way is it predominantly going over the space of a week or a month, alright? If you look at this, the trend is going up, even though, you know, it's dropped down. Overall, the trend is still going up, right? So in general, you wouldn't, if you're a newbie especially, you don't really want to trade against the trend, okay? Now what I mean by that is, if the trend is going up, going long for a buy order, you don't really want to be doing sell orders, okay? You can do them of course, but I would leave that to more experienced traders, because then you can get caught out very quickly, okay? Scalpers is different. Obviously my mate Lee, and partner of the trading guys, he scalps, he literally takes things in every direction for like 1 or 2 candles and then gets back out. Whereas I'm very different. I would you know, try to get in here and get out over here, or you know, get in here and get out up here. But Lee would prefer to get in here and get out here. You know, it's called scalping. So it's just a different method. But you can trade against the trend. It's called a counter trend trade. But it's not recommended for beginners, alright, because obviously it can bite you in the ass very quickly. Obviously you have a flat market where the market's kind of doing this. It's still moving up and down, right? But there's no directional bias. Like this one, you can clearly see it's going up, right? This one, the market still moves up and down. If you're a scalper, you can get involved in this. If you're a swing trader or something, you wouldn't really get involved in a flat market. Not to say that you can't, it's just not your highest probability trade, all right? And then obviously, a directional bias slash trend line coming down would be more like this. So it's still gonna come up, but you can see, obviously, the directional bias, the trend is that it's going short. So if you're a newbie in Forex, then it wouldn't obviously be recommended for you to do a buy order, even although this part here is going up where you could potentially place a buy order. It's not recommended for anyone who's new to do that. You want to be trading in line with the trend line, in line with the market maker, alright? Unless of course you are learning scalping and you have a mentor with you to explain what you can do, then that's fine. But if you're just new and you're scalping on your own without a mentor, then I would not recommend that you trade against the trend. Okay guys? So now guys, I'm just to finish off this video, I'm gonna go over what we call the EMAs, okay? The exponential moving averages, so EMAs. And they are very, very powerful tools, alright? I won't get too much into that side yet. I'm just going to explain what they are, and later on we'll do other in-depth videos purely on them, alright? So, different levels of EMAs. You have the 5, the 8, the 13, the 50, the 200, and the 800 EMAs, alright? And it's basically a line that runs through your trading platform, your MetaTrader, and it shows you where the market was the previous however many days. So the previous 5 days, the previous 8 days, the previous 13 days, the previous 50 days, the previous 200 days, and the previous 800. Now, each level, if the market on your trading platform is above, for example, the 50 EMA. So let's say the 50 EMA, right, is like this. If your candles are like this, and they are above the 50, then it's generally buy orders that you're looking for, alright? Then, when it crosses over your 50 and starts doing this, it's generally sell orders that you're looking for, alright? And now, each level is kind of, it's harder to pass, so each level has a stronger resistance, if you like, okay? The way I look at, if we want to describe the 50, the 200 and the 800 EMAs, right? The way I describe them is, the market can break through a 50 EMA, right? It can break through it with a little bit of resistance. If you look at these, like the 50, strengths of resistance, the 50, I keep in my mind as if it's cardboard, right? You can break through cardboard. It has a little bit of resistance, but if you punch it hard enough, you can break through the cardboard, right? So in my mind, the 50 EMA is like cardboard. The market can pass through it, it can get rejected from it, but it can pass through it with relative ease, okay? The 200 is more like wood, like solid wood. The market can of course break through wood, but it takes a lot more force and resistance to do so, alright? And then we have the 800 EMA, which again, the market can break through it, but it's kind of like concrete, okay? You can break through, or a stone wall, you know? You can break through stone, concrete, but it takes a lot more force to actually do so. And it's the same as the markets. The markets will come, the market will get rejected a couple of times at the 800, it'll pull back, it'll try again, and it'll keep trying to go through, okay? So that is essentially the levels of the EMAs. Now, I will cover very quickly levels of support and resistance. I've just thought about that there, and it's the same kind of topic, so that's why I've just come into my mind why I should cover it here, okay? So you have what's called support and resistance. Now, very quickly how you would come up. Support and resistance lines, right? You will have one of these EMAs, right? You'll have this invisible area in the market where the market keeps coming up and it gets rejected, coming up gets rejected, coming up gets rejected. And when you look at it, it's almost as if the market cannot break through this invisible area, and you're like, why is it not going? So this is what we call an area of resistance, okay? Because the market just cannot break through it. But eventually, the market will come back and it will break through that area and it will keep running, okay? So previously, where this was an area of resistance, because it wasn't letting the market go through, the market's now broke through it, i.e. it's broke through one of the EMAs, right, or a pivot point, or something along those lines. And this area, which was once an area of resistance, now becomes an area of support, and it holds it above the water, if you like. So if this market now tries to come down, and it gets bounced back, bounced back, bounced back, this is now an area of support. So that's how support and resistance works, alright? I hope that's been of use to you. I don't want to drag this video on too long, because I know Forex is quite a dry subject, so I try to keep the video short, sharp and sweet to keep you interested, keep you engaged, and so you guys can learn. On my next video coming up, I am going to show you guys how to do risk management via an application on your phone. I'm going to show you different applications that can help you trade on your phone. And I'm also going to show you and teach you how to actually place a trade, because you would not believe how many people come to us and they're like, look, I want to get involved, but I don't even know how to place a trade. And that's even people that could have done loads of courses before, and it's another common factor that yet for some reason loads of these training courses, they just assume that you already know what you're doing at a basic level, so they don't even bother covering it, okay? So in my next video after this, I'm going to show you how to place a trade, how to do your stop losses, how to work out your lot size, and cover all your risk management, okay? I'm Ryan Mack, this is Trading Guys. Don't forget to like, subscribe, comment, and follow us. And if you want any more information about trading, and you would like to get involved in us, then hit us up on the Trading Guys via private mail. Thanks guys, see you soon.